The dollar is heading for its third straight weekly decline. Jobless claims just had their biggest jump in over 4.5 years. And gold is still hovering around $4,270. Are the markets finally relaxing or just quietly panicking in a more expensive suit? Before you place your next trade, watch this.
Why is fast trade execution a must? Because you're more likely to get the entry price you want and the exit price you want. Reliable, rapid, responsive. Join ATFX today and let's get you started.
Welcome back to the Daily Market Brief brought to you by ATFX Africa. My name is Mbali, and as always, I am joined by our market analyst, Francois Duplessis, to unpack what's really moving the market into the end of the week. Francois, let's start with pound USD. Currently, we've got a softer dollar and a lot of central bank noise. What's happening in the background that traders need to understand?
Thanks, Mbali. Well, the big backdrop is the US story. The dollar index is hovering near 2-month lows at around 98.3, and it's on track for its third consecutive weekly decline. And that's largely because the Fed is, cutting rates as expected, has delivered less hawkish outlooks than a lot of people feared. And Powell basically said further rate cuts are highly unlikely, even though the Fed's own projections only show one more cut next year. Markets reacted by leaning further into the dovish side, adding to that, the Fed is set to buy short-dated treasury bills of around $40 billion in order to support liquidity. Then yields also moved lower, and initial jobless claims rose by the most in nearly 4.5 years, which reinforced the idea that the labor market is cooling. When you mix a softer dollar, lower yields, and weaker labor data, it's no surprise that currencies like the pound are finding support.
So what specifically is driving the cable higher here?
Well, the British pound has surged to $1.34, its strongest level since late October. For the UK side, the market is already looking at the next Bank of England decision. There's roughly an 84% chance of a rate cut that is already priced in. Markets are also almost fully pricing in a second 25 basis point cut by June, with a really strong possibility that it happens in April. At the same time, there are still signs of accelerating wage growth and persistent inflation. So it's not a straightforward everything is dovish narrative. So you've got a dollar that's under pressure, a Bank of England that's easing but carefully, and a market that's more than happy to push GBP USD higher as long as the Fed looks softer than the UK.
And from a technical point of view, where are the key levels you're watching on pound USD?
Well, technically, the cable is clearly in bullish territory. Price is currently holding near 1.34, having broken through a key confluence zone around 1.333. The area combined the 100-day exponential moving average and the 38.2 Fibonacci retracement of the September-November decline, a major hurdle that bulls have now cleared. On the top side, a move beyond roughly 1.347, which is the 61.8 retracement level, could open the door back to that 1.36 handle. On the downside, any pullback may first have to look at breaking that 1.333 initial support. That could open up the doors towards 1.314 or even the deeper support that currently sits at around that psychological 1.3 level, where a decisive break here would start to challenge the current bullish bias. So the trend does lean higher, but it's still very much a macro sensitive move, especially around Fed and Bank of England messaging.
Francois, let's switch to gold. Here we are seeing levels above $4,250 and a 7-week high. What's really driving that move fundamentally?
Mbali, gold is currently enjoying one of its most favorite environments, which is a softer dollar, lower yields, and rising expectations for further US easing. Price is currently trading around $4,275 per ounce, holding near a 7-week high and heading for a weekly gain. Over the last month, gold is up about 2.4%, and compared to this time last year, it's up more than 61%, not far off that all-time high near 4,381, which was reached in October. The reasons tie straight back to the Fed. We've had a third 25 basis point cut this year. Powell signaled that additional hike are essentially off the table, and markets are now pricing in 2 cuts in 2026, even though the dot plot only shows 1. And on top of that, jobless claims rose more than expected, hitting their highest level in over 2 months, which reinforced cooling labor narrative. And if that wasn't enough, the Fed is also, as stated, planning on purchasing $40 billion in short-term treasury bills to ease market strain. That move is expected to cap short-term yields and ease some funding pressure and indirectly support gold, because lower yields reduce opportunity cost of holding a non-yielding asset.
So, Francois, we've got the macro, but what about the chart? How does the technical side of gold look at these levels?
So technically, gold is in a strong spot. Price is hovering near that 4,275 level, consolidating near that 7-week high. The market has pushed back above that 4,260 region, which now acts as important near-term reference point. Recent price action also shows a strong move higher following the Fed's 25 basis point cut and softer jobless data. Persistent buying interest on dips as long as the Fed's tone remains dovish relative to expectations. However, there are some mentions of positive development around Ukraine peace efforts that may cap some of gold's upside, given its role as a traditional safe haven. That introduces, an interesting tension. Monetary policy and yields are supportive, but any perceived reduction in geopolitical risk can limit the urgency to chase fresh highs. Overall, gold still looks like it's trading in a buy the dip kind of environment rather than a panic spike and collapse setting.
Now, let's finish with equities, more specifically the FTSE 100. We've seen a bit of a grind higher on this index. What's behind that move?
Well, the FTSE is getting a nice steady lift from a mix of precious metal miners, quality large caps, and shifting rate expectations. On Thursday, the FTSE 100 rose 0.4%, extending Wednesday's 0.1% gain. So it's not explosive, but it's consistent. The breakdown here is, the strength that we are seeing currently in gold helped names like Fresh Nilo, which was up 4%, and Endeavour, which was up almost 3%. Big defensives such as HSBC, AstraZeneca, and Unilever, as well as GSK, all gained 0.4 to 0.7%. Then we also had names like Rio Tinto and Barclays, which added more than 1%. But everything wasn't positive. On the negative side, Informa fell around 3%, BAE Systems dropped 1.3%, and Rolls-Royce slipped 0.6%. Interestingly, concerns about AI spending and stretched tech evaluations after Oracle's update have eased in Europe, which allowed UK equities to keep grinding higher rather than being pulled back into a tech-led correction. Traders have also boosted bets of a Bank of England rate cuts in 2025, and today's UK GDP print is seen as a potential catalyst that could further shape those expectations.
And technically, where does the FTSE 100 stand right now?
So from a market structure perspective, the FTSE 100 is sitting around 9,735, up 0.49% from the prior session. Over the last month, it is, however, roughly down 2.1%, but over the last 12 months, it's still up 16.74%. It's also trading below the all-time high near 9,930, which was set in November. So what does that say? Well, it says the longer-term uptrend is still intact. The most recent price action looks more like a consolidation phase after strong gains rather than a full-blown reversal. In other words, the FTSE isn't sprinting, but it's also not rolling over. It's doing what mature bull markets do: rotating, digesting, and waiting for the next clear macro signal.
Francois, before we wrap up, looking into next week, what should traders keep a close eye on after this week?
Well, Mbali, there are a few key threads to watch. For the cable, well, the question here is, can the pair hold above 1.33, or does Bank of England communication and UK data, especially the GDP and the upcoming Bank of England decision, pull some of that enthusiasm back? For gold, here the question is, does price manage to stay above 4,260 as the markets keep leaning towards more easing than the Fed is officially projecting? And lastly, the FTSE 100. Does a mix of Bank of England expectations and Ukraine macro data keep the index grinding higher? Or do global risk stories, especially around tech and AI, finally start to weigh more heavily? Well, regardless, the big theme into next week is simple. We know what the Fed did. The question is how long the market is willing to trade the less hawkish than feared narrative before something else steals the spotlight.
Francois, thank you so much for the insights, and I'll let you close us out.
So traders, that wraps up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to atfx.com by clicking the link in the description and we'll go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.